Welcome to our Stearns Financial live chat. I am joined today by Tara Maxwell, Stearns Financial's Financial Planning Manager. And Tara and I are going to explore some of the possibilities for change in 2021, changes in stimulus plans, changes in tax plans, and things beyond that. So welcome, Tara. And let's get started. Oh, a reminder to our audience that if you do have a question, use the Q&A feature, not the chat feature. Thank you.
Thank you, Dennis. And before we jump into what may be in some of the proposals that we're looking at for 2021, I just want to remind everybody what was not in the December stimulus package. Two important items that might apply to many of you. One is that the RMD waiver that we saw in 2020 was not extended to 2021. And just to give you a little insight, it is not actually in the proposal to be in the new stimulus for 2021 either. So far, we do not expect to see that occur. The other impact that happened that did not happen in the December stimulus is the distributions from retirement plans that were able to occur because of COVID-related challenges. Those have not been extended, so you cannot make those distributions with the favorable tax treatment that you were able to receive in 2020. So now let's jump into what is in the stimulus bill proposal. And I want to highlight that this is definitely a proposal, and we probably will see negotiation from here. This is probably not what we're going to actually see come to fruition. So in the proposal, a few of the key items are that we're going to help fund administering 100 million vaccines. There is a lot of talk about how to slow the virus spread. That's going to include funding for increasing testing and increasing the contact tracing that I know has been challenging. It also is going to provide funding for additional supplies and protection for our frontline workers. It also will add funding to pay for employees to stay home when they feel ill. So there is some provision for that now, but it's going to expand that provision is what's in the proposal. It also proposes that we hire an additional 100,000 frontline public health care workers to help with various things, treating COVID patients, also administering vaccines and different things like that. Another big budget item in the stimulus proposal is to fund schools so that they are able to reopen. Kindergarten through 8th grade is going to be the focus so that they can go back and have in-person education for schools that are not currently able to do that. So that will fund a lot of the extra cleaning of the requirements, and do we need extra space and items like that.
And we know a lot of moms who are really pulling for the success of that particular piece.
Yes, to at least see some sort of hybrid maybe at a minimum. It also includes additional $1,400 payments per person. And these payments, if they were to be distributed as they're described today in the proposal, they would be sent out to everyone who received the $600 payment in December. So that's $1,400 in addition to the $600 payment that was out in the December proposal.
And I'm sure many of our audience have read the back and forth that was happening around the time of the December stimulus package, that there were a number of folks calling for $2,000, President Trump at the time being one of those, and some Republicans, but the Republicans were beginning to push back on future budget deficits and things like that. And so this one's going to be kind of an interesting one to see how it works its way through, not just the House, but also the Senate, where there's a razor thin margin and probably a lot of as they say, sausage making and horse trading that's liable to happen on many of these points, but that one in particular.
The next proposal that we're going to talk about is extending unemployment benefits. And that additional payment in this proposal is $400 per week. In the December proposal, in the December stimulus, it was $300. So a little bit of difference there. And if you remember back to the first stimulus package, it was $600 at that time. It also is going to provide for grants and loans for small businesses. We don't know exactly what that's going to look like, but again, that is a topic that's being addressed in the stimulus proposal. And
I'm sorry, Tara. I was just going to say, this is one in particular that we are hoping gets done in a good way. The original PPP program had many issues, many problems. Some companies that were mega large were getting large benefits out of it. And many of the smaller businesses that really needed it had difficulty getting it. And so if they can get this one right, that is pretty key to the rebound of the economy in 2021.
Yes. The other item that's in this proposal that we want to talk about is the increased tax credits. And so these are going to be not only tax credits, but also the proposal is to make them refundable if you don't owe the tax dollars. And they're going to be for families with children. And as we flip to the next slide, we'll look at the details of what those two items are. One is to temporarily increase the child tax credit. And so you can see those amounts and they vary based on the age of your child. The second, which may be a larger impact, is to double the child independent care expense. So currently you can receive $8,000 per child and it's going to go up to 16. And this is the one that they would hope to make refundable. And so this would help working families where they do have children that do still need to go to care during the day.
So one of the things that many of our clients have been asking about lately is what do we think the tax law changes will look like in 2021? And so major tax reform, we actually have in the red category on the stoplight. That major tax reform seems unlikely, partially because there is a major focus on the COVID-19 endgame, trying to make sure that that gets on track and stays on track. And so there's a higher probability that that would be kicked forward into 2022. Now, the key here, though, is there are some modest tax reform items that are probably in the yellow camp. They may be later this year. And so some of those changes, there's just a few little adjustments that can be made to the existing tax law, which we'll get into in a minute, that can help raise some revenue and get towards some of the goals that the Biden administration has. And then minor tax reform, again, we would put in the very likely category. You've already heard on the last slide, there's some other things that are going on that are not in a package in particular, but are embedded in other bills that are going to work their way through Congress.
So Dennis, as you mentioned, we might see some of the modest tax reform. So we have picked three to really highlight here. The first that we feel may be the most likely for us to see in 2021 would be for a reversal of the highest marginal tax rate. So currently that tax bracket has a 37% rate. Prior to the Tax Cuts and Jobs Act, that bracket was 39.6%. And so we think there could be a reversal back to the higher rate this year. In addition to reversing that highest tax bracket rate, there is significant talk of changing who that highest tax bracket impacts. And so currently it's around income over $628,000 a year. And there's talk of lowering that to include income of $400,000 per year. The third item that we've put on here that we potentially could see in 2021 is additional Social Security tax. And this would be tax where the employee and the employer both pay an additional 6.2% for those who are earning over $400,000 in income. Currently, this tax is paid by everyone until they earn over about $142,000 is the limit this year. So Dennis, one thing I'll add here is the first 2 points on this slide would very likely pass if we had to go to a budget reconciliation to get tax law put into place, but the Social Security tax most likely would not if that's how we have to come to an agreement.
Yep. So again, we're prognosticating on some things here that we will keep you up to date on in our written chats and live chats going forward.
So in our next slide, we're going to talk about what are some of the additional tax proposals that are out there that we feel are probably more likely to pass into the 2022 tax changes when we do see a full tax bill come out, most likely. Now, again, there's going to be interim elections, so maybe we revisit that then. So again, just a proposal and what's in there. But in these proposal items, they're talking about taxing long-term capital gains for people over $1 million at the ordinary income rate. So if you're in that highest tax bracket, your capital gains, instead of being taxed at the 20% rate like they are today, jump up to that 39.6% rate if this were to pass. And again, remember, this is proposed only for those with over $1 million of income on their tax return, so won't impact everyone. The next item, it has been talked about as one item, but it's all about the Schedule A, or your deductions on your tax return. So first, I'm going to talk about eliminating the SALT limit. So currently, under the Tax Cuts and Jobs Act, we are only able to deduct up to $10,000 of state or real estate taxes. And so a lot of people are paying more than $10,000, but they're only able to deduct that $10,000 amount. The other item that's coming in line with this is capping the itemized deduction at 28% of your total income. And so what will be interesting, Dennis, about this is if we allow people to deduct more in state taxes, but it's limited to 28% of your income, and they have significant charitable deductions, it may actually make it where the charitable deductions are not fully deductible in that year, and there would have to be some carryover. So that'll be something interesting for us to watch for clients. The other item that we've seen is reducing the estate tax exemption. So currently it's a little over $11 million per person, and that would go back down to around the $5 million range per person. The reason we didn't put this in the proposal for 2021, where it seems like an easy adjustment and one that could pass, it has a smaller impact to the revenue. And so that's why if there's discussions and debates, it's probably not going to be the hot topic.
Yeah, there was some discussion on this. If there wasn't a razor thin margin in the Senate, there was even some discussion of it going below 5 million per person, but that just seems very unlikely now, given where we are.
The next proposal item that we want to talk about is eliminating the cost basis step up on inherited investments. So currently under the law, if someone passes away, and let's say that they had bought a stock and they had paid $10 for it, but it's increased in value up to $1,000, when that asset's inherited by someone, the basis goes up to what it's worth on the day that the person passes away. And so the person passing away doesn't have to pay a gain tax on that when somebody passes away. So if that goes away, what the discussion is that immediately that would become taxable to the person that passes away on their final tax return. So that's how that would work. Again,
Yeah, and we're gonna get into that a little bit later, some of the nuances around that.
another item that's related to that same kind of cost basis adjustment is the tax on gifted assets. It works a little bit differently, but if I bought a stock and I paid $10 for it and it went up to the $1,000 and I gifted it to Dennis, when he gets my stock, he's going to keep my $10 basis in it under current law. This proposes that when I gift it to him, that I would pay the gain before I actually gift it to him. So I would be taxed on that gain.
So does that mean you probably aren't going to gift that stock to me, Tara?
It might mean that.
Yeah, so that one, again, for some of our clients is a very important point.
This is another item for our business owners that there is lots of talk of increasing the corporate tax rate up to 25 to 28%. So we would not see those benefits that we've seen in the last few years on the corporate tax return.
Yeah, and that's one we've been talking about for some time now as a possibility that would create some headwinds for the US stock market. And so this is one, I mean, all of these we're keeping an eye on, but this is one we're keeping a very close eye on, because if it looks like it's going to be 2021 instead of 2022, that could change some of our forecasts.
The next item on here is the phase out of the 20% qualified business income deduction. And that would phase out only if you have income over the $400,000 mark is the new phase out for that, or proposed phase out. Another big item that can impact people who invest in real estate. Currently, under today's law, you can sell a real estate property. And if you purchase a similar property, and you have to make sure it's similar according to the IRS definition, that you can keep that cost basis and you don't have to recognize the gain when you sell that property because you're reinvesting in something similar. So if that goes away, we would see additional taxes due as properties are sold over time.
Yeah, and this is a tool that a number of our clients have used, and we've expanded into opportunity zone investments and a number of other things in recent years. But it looks like there's a reasonable chance that one of the tools may go away.
And Dennis, I'm going to add two items that are not on the slide that I have been reading about for tax proposals. One is for people making qualified plan distributions. So for many people, that's a 401k savings that they're doing. Currently, the way that works is you get a tax deduction because it's lowering your income. And so your benefit that you receive is based on the tax bracket that you're in. The proposed change is that there is a tax credit. So everyone would receive the same percentage benefit if it switches over to that. So it's just a little bit different way of putting it on the tax return. It will help benefit people who are in those lower tax brackets. The other item that some of our clients may be excited about is the first-time home buyer potential. And so there potentially will be up to a $15,000 first-time home buyer tax credit.
So as one of my accounting friends quipped the other day, this is the full Jobs Act for the accounting profession with all these new nuances that could be put in.
On our, oh, go ahead, Dennis.
No, I was just going to say the estate tax is the next one. Go ahead, Tara.
So estate tax, and we hit on this in some of those additional proposals that are out there. But what we can see is if we're looking at the blue color, the estate tax, when it was increased with the Tax Cuts and Jobs Act, that was significantly higher estate tax exemption than we've ever seen historically, as you can see on this graph. And so we do expect that probably in one of these bills, when we get a full tax bill, that will decrease. And as Dennis alluded to earlier, it probably will decrease back down to the $5 million range, not lower than that would be our expectation.
Yeah, I think the important piece here is it's really clear from that last chart that it's only been in recent history that those estate exemptions have really gone up substantially. And that was good because we had asset inflation. I mean, just inflation in assets causing estate taxes for folks before they started going up 15, 20 years ago. And we've continued to have that asset inflation. So as Tara mentioned earlier, there's really not a significant amount of money raised in this area compared to some other areas. But it's a philosophical area that is definitely a hot potato for political purposes in terms of who should be taxed at death versus life. And again, we know that many of our clients say, well, wait a minute, I've been taxed once, maybe twice during my life, and now I've got a third tax at death. How much of any of that is fair? That's a little beyond our discussion today. It's more about what the reality is going to be and what we're going to do for planning around it, which gets us to the next slide. So some of our higher net worth clients have been already considering accelerated gifting to children or grandchildren. And so that annual gifting cap that you get no matter what is $15,000 per donor per recipient. So the couples giving to a child or grandchild can double that at $30,000. And so, you know, as long as you are convinced that your financial independence is in good shape, and we've actually been having a number of those discussions lately with clients who want good margins of safety out when they get older, and how much is the amount that they want to gift. But as long as you feel comfortable with that, that may be something to do, particularly if you're above 10 million in total assets. Now, we always remind folks that by the time you die, tax laws may have changed once or twice or even 3 times again. But it's a little hard to see this estate area getting back to the numbers we had in the 2017 tax law anytime soon. So we may be living with something closer to what's coming for a while. And there may be inflation adjustments that are built in, but they will be modest over time. The other piece that a number of our clients are noodling on is if there's no concerns about in-laws, that you could double the annual gifting. So if you want to give to a child and their spouse, and it's a couple giving, you could do $60,000 and it would not affect your lifetime exemption. And we do have some clients taking a look at that. And again, that number would be cut in half if you're single currently. And just a reminder, this remains true, and at least from everything we've heard so far, may still remain true. Direct payments for medical and educational costs are excluded from any of these gift limits. So if your grandchild has an emergency appendectomy and it's not fully covered by insurance and there's a $10,000 extra cost, if you chose to, you could fund that, and that does not count towards your gifting amounts. The lifetime gift exemption we've already talked about could fall to $5 million per person later this year. Here's the kicker. It is unclear at this point whether the change would be effective with the date of the legislation or retroactive to 1/1/2020. And so in the past, some of these estate restrictions have been effective with the date of the legislation. And if this gets done later in the year, or into early 2021, or 2022, I should say. But if it gets, yeah, on that date, I just realized there's a typo there. It should be retroactive to 1/1/2021, not 2020. So if we're later in the year, it's entirely possible that on the Estates Act side, it could be effective with the date of legislation. Now, the income tax provisions, it is very unlikely they would be effective on the date of the legislation if it happened later this year. That would be a complete mess for the IRS and everybody to try to figure out. So again, the 2 points that are critical: only increase gifting if you're comfortable. It won't impact your financial independence, including downside scenarios. And Tara and her team continually are coming up with more fire testing capabilities in our financial roadmaps. And then only increase gifting if you have no concerns about affluenza. And we do have a few clients. Affluenza is that entitlement mentality. We do have a few clients that have a few children or grandchildren that they are concerned about that with. And so we've had very mature conversations about what should be the balance between the gift and not creating unintended behavior. One of the things too that we ought to mention is that back up under the direct payments piece, the payment needs to go directly to the organization. So in that emergency appendectomy example that I gave, you'd have to write that $10,000 check to the medical provider, writing it to the parent of your grandchild. It would not circumvent these rules. So it has to go directly to the organization. Let's go to the next slide. And this is where we pause for reflection on the sunset. The sunsetting of highest federal tax rates. And so again, this is one, this is going back quite a ways in terms of what the long-term capital gains are and what the regular ordinary income tax is. And as you can see, back in the 60s and even 70s and 80s, those rates, particularly the ordinary income rate, that sort of greenish line, were pretty high. And then a lot of the things that came in with Ronald Reagan is some of those changes in the 1980s where ordinary income rates came down, the capital gains tax rates came down, they bounced around, as you can see. And so where we are today, ordinary income tax rates are higher than capital gains. And so the reality, and we talked about this a little bit ago, is that going forward, some of those capital gains rates that blue line may trend up to the green line, but only for higher income folks. And that's the key. Tara and her team, we do a lot of financial roadmaps. We see a lot of different circumstances, a lot of different budgets, nuance, one size fits one in terms of each individual. And the thing that we've noticed in many of them is that the tax rates, even under these new tax laws, may not have as big an impact as maybe you fear that they will have. Now, the caveat to this is that folks with very large retirement plans are looking at larger required minimum distributions as they get into their 80s and their 90s. And so the surprise is more ordinary income is actually coming out. And so in some of those cases, maybe we'll start pushing towards the higher end of whatever the new tax laws are. Tara and I did a program on that about 6 months ago, which included some of the potential increases in taxes due to budget deficits going up. And so again, this is all something we're going to have to keep an eye on and make appropriate adjustments as we go. And so again, tale of two tax rates, and again, it may be the tale of 10 tax rates going forward. It's very likely that capital gains rates will increase substantially in 2021 or 2022 for some of our higher income clients. And Tara already mentioned the $1 million piece in particular. There's probably going to be some gradation from 400,000 to $1 million in terms of how much capital gains rates increase. I mentioned the older clients with retirement plans and the fact that many of our financial independence roadmaps suggest that these tax rate increases are not going to have a massive effect or material impact on future financial independence. But again, that's one size fits one. And we have been encouraging everybody, freshen up your roadmaps. Well, as we get more information in the next 6 months, maybe 12 months on these tax law changes, we're going to be additionally freshening up some of those roadmaps to taking those things into account. And then, Tara, do you want to just reinforce the point on QCDs here?
Yes. So the qualified charitable distributions, or QCDs, as we talk about it, that Dennis mentioned for those who have large IRAs. Now, I'm going to emphasize IRAs because QCDs cannot come out of qualified plans like a 401k. But if someone does have that large IRA in retirement and they don't need all of the money that's required to come to them, they have the ability to, again, directly send money to a charitable organization. And then that counts as satisfying part of that required minimum distribution, but it never shows up as taxable income. So it never shows up on that first page of your tax return, which is a nice benefit for those who do have charitable intent and who also have required minimum distributions that are above what they need to spend. And Dennis, one other point that I'll emphasize as you've been talking about roadmaps and reminding clients, I just want to remind you, if you've gone through the roadmap process, from the very beginning, when the Tax Cuts and Jobs Act went into effect, and the tax rates for many are a little bit lower than they were before that law went into effect, we only capture those lower tax rates through the end of 2025. And so the plans already account for some type of tax adjustment to occur from 2026 throughout the end of the plan. We know from these proposals, it looks a little different than what we're modeling, and we'll change that as we see what really comes to fruition. But there already is at least some tax adjustment in the plans. We're not using the lower rates that we're seeing today.
Yep, that's a good point, Tara. And so this issue of using the QCD, qualified charitable deduction, out of an IRA versus appreciated assets, gifting those to a charity of your choice. We have done a lot of analysis on this over the years. And, you know, sometimes it tilts you one direction or the other, which one makes the most sense. We got a lot of tax law changes, folks, coming up that could change that dynamic. If the cost basis step up goes away, then getting those assets out of your estate is a really good thing. But if you're going to be taxed at higher rates on your IRA downstream, getting money out of your IRA makes a lot of sense. So again, I think it's going to be maybe even taking this analysis to a whole new level with some of these proposals that are coming down the line. And so that gets us to the cost basis conundrum. Say that fast 3 times. And so Tara already went through some examples on how this works. And I think the real key here is that we have some clients who have held on to some things for a long time, and maybe the economics of a particular asset aren't quite as stellar going forward, but maybe it has a huge embedded tax that would go away at their death. Well, if this changes, and we would put this in the fairly green category of happening, either this year or next year, If this changes, I think we're going to have to rethink some of that because you're immediately going to have a tax at death. And so it may make as much sense to try to take some of those gains in advance, but maybe not in a large lump sum, because again, that could throw you into higher brackets. So maybe it needs to be gradual over a period of time. You know, several of our folks in our firm refer to it as the capital gains budget. You know, what is the budget that doesn't throw you into either too much of a higher bracket or doesn't trigger the IRMA, the provisions that increase your Medicare. Now, again, IRMA, every analysis we've done is it feels like a large dollar amount when it blips up to a higher level on it takes away from some of your Social Security payments, but it's relatively small percentage in terms of the decision. But you have to put all those things in a blender, and again, Tara and I both see the blender getting a little more complicated here going forward. Okay, now we get to the really easy topic to talk about, federal budget deficits. So this is something that, again, is going to be updated as we see what kind of additional stimulus package happens. So the 1.9 trillion that has been suggested, that could go down to 1 trillion, just depending again on the horse trading that goes on within Congress and the president. And so that 1 trillion or 1.9, who knows, maybe it's right in the middle, 1.5, whatever that number works out to is an add-on to some of these numbers that we see from the CBO forecasts on the right-hand side. And there is likely to be an infrastructure plan. Now that infrastructure plan, if it's well constructed, may be like the Eisenhower infrastructure plan and actually be accretive to the economy, to the gross domestic product growth. And so maybe that one in some respects helps pay for itself. But that will be coming right behind this $1 to $1.9 trillion additional stimulus. And again, as Tara said on the very front end of this discussion, some people forget, we just had 900 billion in December that went through. So what you're looking at on this chart in the upper right-hand corner is the annual federal budget deficits. And so you can see the projections are that they are very spiky in 2020, kind of a spike in 2021. And again, we would suspect that if we're looking at this chart 6 months from now, that 2021 number will be much higher. But then it goes down to a much lower percent of gross domestic product, GDP, on an annualized basis. And that's as the economy gets back into a more normal state, tax revenues get back into a normal state. And then on the bottom right, as we've talked about many times in the past, this is really the key. It's not the actual number because you got to relate that number to something. And it's the number compared to GDP. And so what you can see here is that we are moving into higher territory as a result of the pandemic that we haven't seen since World War II, that blip in the line on the left side of that chart. And so that higher percent, where it's over 100% of the value of the economy, doesn't necessarily portend tremendously negative things near term. We all reminders that Japan, has been sitting at 150, 200% for 20 years and hasn't crashed into the sea, but it definitely creates a lot of issues as that percent relative to the economy gets higher. It's interesting, we've had Janet Yellen, the incoming Treasury Secretary, a few other people opine that maybe if we refinance some of this or finance some of this using 30-year bonds at 2%, that we would mitigate a lot of the future risks around some of this. And so again, low interest rates mitigate that deficit risk anyway for a while. But the question is, how long is a while? Is it 4 years, 5 years? Is it longer? The future funding deficits from 30-year bonds at 2% lowers rising interest rate risk. And we should mention that just recently we had some of the strongest 30-year bond auctions that we've had in decades. So there is definitely very strong demand. Now, some of you may say, who would buy a bond paying 2% for 30 years? But there's a lot of sovereign wealth funds, pension plans, others around the world where they're in their home country, the interest rates are negative. So 2% in the strongest country in the world currency looks like a pretty good deal. And so just a reminder to everybody, governments have 4 methods of lowering deficit risks. Growth, growing the economy, adds to revenues, and that certainly is a good one. Inflation lowers the future cost of paying back the debt. Maybe we'll see a little extra inflation added in. That again is a subject we're going to be looking at very closely in the next year or two based on all the stimulus that's been going on. Raising taxes, we've already talked about that in previous chats. We would expect that to happen beyond what may be about to happen in 2021, 2022. We would expect that to happen, but probably not for at least 6 to 8 years from now. And then cutting spending, which is always hard. I mean, that's the one that probably should be number 1 on the list, but it's always hard since many voters feel the impact more directly, and politicians often listen to those voters carefully about being careful where they cut spending. So we're probably a little less optimistic that number 4 will be one of the solutions to the longer term deficit issue. And again, some of this gets back to that number 1 item, is what can be done by the country, perhaps aided by a new infrastructure plan and some other things, to make sure that growth is at least trend or above trend for some time to come. That will help with part of this future budget deficit. I have a feeling that we're probably going to be having annual discussions on this topic, maybe even more frequently as time goes on, because it is a hot potato. You know, it's something that had to be done relative to the pandemic, just to make sure we didn't get into a much worse condition. But now we have to figure out how to mitigate the longer term risks. So Tara, you want to take us home with the summary?
Sure, Dennis. So just to remind you, what are the key takeaways that we've talked about today? I think for taxes, the key takeaway is we may see some smaller changes that will have some bigger impacts on certain people in 2021, but we're probably not going to see everything that the Biden administration would like to take place until at least 2022. Probably the tax changes that we see in 2021 and even into 2022 are probably not as significant as some people really fear. We're not going to see, if you remember 6 months ago when Dennis and I did a chat just on taxes, that maybe 8 years from now, we see significant tax rate changes, but we probably are not going to see that in the next couple of years. But some clients will feel the pain of what is changed. That leads us right into the next point, that every client situation is unique, and we want to take your unique circumstances into account when we do your plan and we think through what you might want to do in 2021 or what you might not want to do in 2021 with all the unknowns out there. As the year goes on and we have a little more clarity as to what may be impacted exactly in 2021, we will take closer dives into everyone's situation and see how we need to make those adjustments. The next point is a reminder that most clients are going to be fine staying the course, that we have shown scenarios with various things having a negative impact on plans, And we've created margin of safety in most of our plans. And so having a little bit of tax inefficiency is going to be okay. And maybe we need to make some modest adjustments. As Dennis says, we might need to go from the filet to the sirloin, but we probably don't need to go from the filet to the Spam or the hot dog.
Yeah.
The other thing is that the higher income clients, there probably are going to be more planning opportunities this year. We're probably going to need to think through those tax situations a little more carefully. We obviously and always remind you to coordinate all of your planning with your other advisors. We want your CPA, your tax, estate attorney to be involved in anything that we do before we make any major changes. And that is a good reminder into the last point that we want to carefully consider anything that we do that we can't change. Anything that we do today that's not reversible, that we can't unwind, is probably requires everybody to be on the same page and understand all the pros and cons there, because we don't want to do something that we can't come back and adjust later.
Yeah, great point, Tara. And the economics first piece, this is just another way to say don't let the tax tail wag the economic dog. But given some of the worries that people have about what will be happening with tax rates in 2021 or 2022 for some of these things, we're hearing a lot of things that would suggest let's try to get more tax efficiency into the equation, and we're all for that. But we also want to make sure we're in the right economic places. We've had an absolute incredible pivot in a lot of different areas as a result of the pandemic, and we expect that to continue. So again, it's going to be balancing the tax efficiency piece, tax planning where we can do it, with the let's make sure we have our economics in the right place. No small feat in today's environment. All right, and with that, I think we've covered some of the questions, frequently asked questions we've had from our clients. I'd like to thank Tara for doing a dive into all of these. And again, we are probably going to be having several of these this year. So we'll be updating you as we know more specifics on things. And again, I would appreciate everybody thinking about, what can they do this year for their own personal situation to make sure that you're where you need to be relative to your financial roadmap. So, sometimes people do the roadmap and they put it on the shelf and it gathers dust, but occasionally pull that out and say, oh yeah, I needed to do 1, 2, and 3, and just try to make sure that we're on track. We certainly in our meetings with you will help you think about some of those things as we go along as well. On behalf of Tara and the entire SFG team, thank you for watching today. And again, we appreciate any feedback you get. This will be loaded up to our YouTube channel. It has been recorded today, so you can watch it at your leisure at a later time. So thanks everyone. Have a great weekend.